For decades, the Northeast of the United States represented something more than geography. It was permanence. It was history poured into brick and brownstone. It was the idea that some places simply never lose value. New York, Boston, New Jersey suburbs, Connecticut shoreline towns. These markets didn't just sell homes. They sold certainty. And for a long time, certainty paid very well. But today, something feels different. Listings sit longer. Open houses feel quieter. Price cuts, once unthinkable in prime neighborhoods, are becoming routine. And the question nobody wants to ask out loud is simple. Is the Northeast real estate market losing momentum? Or more uncomfortably, did it already lose it? To understand what's happening now, we need to step back, far back, before interest rates, before remote work, before pandemic shockwaves. We need to understand why the Northeast became powerful in the first place. Because markets don't fall randomly. They unravel when the forces that built them begin to reverse. The birth of a real estate powerhouse. The Northeast didn't rise by accident. It rose because it sat at the intersection of industry, finance, education, and political power. In the late 1800s and early 1900s, America's economic engine roared to life along the Atlantic corridor. Factories, ports, railroads, banks. Immigrants poured in by the millions, and cities like New York and Boston became gateways to opportunity. Housing wasn't speculative then, it was necessary. People lived where the work was. And the work was here. By the mid-20th century, this concentration of jobs did something critical to real estate. It locked demand in place. Even when other regions boomed and busted, Northeast cities remained anchors. You didn't just buy a home there. You bought access to capital, to networks, to institutions that shaped the country. That's how property became power. The myth of the unbreakable market. By the 1980s and 1990s, Northeast real estate had earned a reputation that bordered on myth. Prices always recovered. Rents always rose. Land was limited. Zoning was strict. And scarcity creates confidence. When markets elsewhere crashed, investors told themselves one thing. At least it's not New York. Even the 2008 financial crisis, brutal as it was, reinforced this belief. Yes, prices fell, but they bounced back faster than most of the country. By the mid-2010s, Northeast cities weren't just recovering. They were outperforming. Luxury condos soared. Suburban homes became bidding war magnets. Foreign capital flowed in, treating property like a bond with better returns. And then came 2020. The shock that changed everything. At first, the pandemic looked like a temporary disruption. Offices closed. Cities emptied. People fled to the suburbs, or so it seemed. But underneath the chaos, something structural was happening. For the first time in modern history, work became detached from place. You no longer needed to live near the office. You just needed Wi-Fi. And that single shift quietly challenged the foundation of Northeast real estate. Because when access to jobs stops being location-dependent, location loses leverage. Pause. People didn't leave because they hated the Northeast. They left because they realized they didn't need it the way they once did. The cost of staying. For years, high prices were justified by high opportunity. But once opportunity went digital, costs started to feel heavier. Property taxes, state income taxes, aging infrastructure, smaller homes for higher prices. Suddenly, people were comparing, not emotionally, but mathematically. Why pay more? For less space? To commute less? To a job that no longer required proximity? That question didn't have a satisfying answer. And markets hate unanswered questions. Early warning signs. At first, the changes were subtle. Luxury rentals took longer to fill. Developers offered incentives instead of price cuts. Buyers hesitated just a little longer than usual. But momentum is fragile. It doesn't disappear overnight. It slows, then stalls, then reverses. By 2022 and 2023, cracks were visible. Sales volume declined even when prices stayed high. That's a dangerous combination. Because volume tells you truth. Prices can be defended. Volume cannot. When fewer people are willing or able to transact, confidence erodes. And once confidence erodes, narratives change. The interest rate reality. Then came higher interest rates. And suddenly, the Northeast's long-standing strengths became liabilities. High prices meant higher monthly payments. High taxes meant less flexibility. Older housing stock meant costly maintenance. In cheaper regions, buyers could adapt. In expensive regions, buyers stalled. And sellers remembered yesterday's prices. Markets don't fall because people panic. They fall because sellers and buyers stop agreeing on reality. Pause. And that's exactly where the Northeast is now. A market caught between eras. This isn't collapse. It's something more uncomfortable. It's transition. The Northeast is no longer the unquestioned default for ambition. It's no longer the only place where careers are built. And it's no longer immune to comparison. That doesn't mean it's finished. But it does mean its old playbook no longer works. Scarcity alone isn't enough. Prestige alone isn't enough. History alone isn't enough. Markets must justify themselves every day. And the Northeast is being asked to do that again for the first time in generations. So what happens next? Do prices fall? Do buyers return? Do cities reinvent themselves? Or does momentum continue to drift, slowly, quietly, south and west? Those answers depend on decisions being made right now. Policy decisions, tax decisions, infrastructure decisions, and perhaps most importantly, decisions about what the Northeast wants to be next. Because power isn't permanent. It has to be renewed. Momentum never announces its exit. It doesn't ring a bell. It doesn't break headlines at first. It simply fades. And the only way to see it clearly is through data. Because while opinions argue, numbers don't. When analysts first noticed something unusual in the Northeast, it wasn't prices. Prices are sticky. They resist reality. It was volume. When fewer people show up. In healthy real estate markets, volume leads price. People buy first. Prices follow. But in the Northeast, beginning in the early 2020s, something flipped. Transaction counts began to fall, sometimes sharply, while prices hovered near record highs. That's not strength. That's tension. It means fewer buyers are willing to participate at these levels. And when buyers hesitate, sellers quietly lose leverage. This pattern appeared across major hubs, from New York City to Boston and their surrounding suburbs. The story was the same. Homes sold, but slower. Listings accumulated. Price reductions increased, not dramatically, but steadily. The kind of steady that changes markets. The migration that wouldn't reverse. For years, migration data told an uncomfortable story. People were leaving the Northeast. At first, it was dismissed. They'll come back. They always do. It's temporary. But then the pattern held. Year after year. More residents moved out than moved in. And they weren't just retirees. They were professionals, families, high-income earners, the very people who once anchored housing demand. Where were they going? Places with lower costs, lower taxes, newer homes. States like Florida and Texas didn't just gain population. They gained confidence. Confidence fuels housing. Remote work wasn't the cause, it was the accelerator. Here's the mistake many analysts made. They blamed remote work. But remote work didn't create the problem. It revealed it. High housing costs were tolerable when proximity was mandatory. Once proximity became optional, trade-offs became visible. A smaller apartment, higher taxes, older infrastructure, compared to more space, lower monthly costs, newer construction. People didn't flee cities emotionally. They left rationally. And markets built on emotional attachment struggle when buyers turn analytical. The suburban shift and its limits. At first, suburban Northeast markets looked like winners. Prices surged. Bidding wars returned. Inventory vanished. But even that had limits. Because suburban demand was still tied to regional economics. High state taxes followed buyers outward. Infrastructure costs didn't disappear. Commutes returned as hybrid work took hold. The suburbs absorbed pressure but didn't eliminate it. Eventually, affordability hit a wall. When both cities and suburbs become expensive, demand doesn't stretch forever. It relocates. Affordability, the quiet governor of all markets. Affordability doesn't care about history. It doesn't respect prestige. It enforces math. As interest rates rose, Northeast buyers were hit harder than almost anywhere else. Because high prices magnify rate changes. A 1% increase doesn't just raise payments. It redefines who qualifies. Thousands of buyers didn't choose to wait. They were priced out. And when first-time buyers vanish, the entire market slows behind them. Investors begin to hesitate. Institutional investors are early movers. They read cycles professionally. And quietly, their appetite for Northeast residential real estate began to cool. Not disappear, but redirect. Capital flowed toward faster growth regions with lower taxes, higher population inflows, newer housing stock. Returns matter more than tradition. And when capital reallocates, momentum follows. The psychology shift. Markets run on stories. For decades, the Northeast story was simple. Buy now or regret it later. But stories evolve. Today, the story sounds more cautious. Wait and see. Let's negotiate. Maybe prices come down. That change alone reshapes behavior. Urgency fades. Patience increases. Sellers feel pressure first. This isn't a crash, it's a repricing of reality. It's important to be precise. This is not 2008. There's no widespread subprime collapse. No forced liquidation wave. But there is something else. A reassessment. Of value. Of necessity. Of what justifies a premium. And reassessments are slow but powerful. Why this shift matters more than it looks. When markets lose momentum, they don't just slow. They stop pulling others forward. Construction pauses. Renovations delay. Local economies feel it. Real estate isn't isolated. It's connective tissue. And when the Northeast weakens, ripple effects spread. Which brings us to the next question. If the Northeast is losing momentum, who is gaining it? And more importantly, what does that mean for the next decade of American real estate? Momentum never disappears. It migrates. And if you want to understand what's really happening to Northeast real estate, you don't just study what's slowing down. You follow where the energy is flowing next. Pause. Because every real estate shift in history has followed the same pattern. One region loses certainty. Another gains belief. The gravity of growth. In real estate, growth behaves like gravity. It pulls people, capital, and construction toward it. Over the last decade, but especially since 2020, that pull has intensified in specific parts of the country. Not by accident, but by design. States like Texas, Florida, Arizona, and North Carolina didn't just benefit from migration. They prepared for it. Lower taxes weren't the whole story. They built infrastructure. They approved housing. They welcomed employers. And markets respond to welcome. Jobs move first, housing follows. Here's a rule that never breaks. Jobs lead. Housing reacts. Corporate relocations didn't just change office maps. They rewired housing demand. When major employers expanded outside the Northeast, they didn't just bring payrolls. They brought confidence. Confidence that local economies would grow. Confidence that homebuyers would follow. Confidence that capital would earn returns. And once confidence sets in, housing accelerates. The Sun Belt isn't cheap, it's flexible. There's a misconception that growth markets succeed because they're cheap. That's only half true. They succeed because they're adaptable. When demand rises, supply responds. Builders build. Zoning adjusts. Infrastructure expands. Compare that to much of the Northeast, where housing supply remains locked behind decades of regulation. Scarcity once drove prices up. Now it drives buyers away. Flexibility beats tradition in modern real estate. Space became a luxury. Another quiet shift reshaped buyer priorities. Space. Not just square footage, but psychological space. Home offices. Yards. Parking. Privacy. These were once optional. Now they're expected. In regions where new construction is easier, housing evolved with demand. In older Northeast markets, evolution was slower. And when housing fails to adapt, buyers adapt instead. They move. Capital always chooses momentum. Institutional investors don't fall in love with cities. They follow math. And the math now favors population growth, regulatory ease, and long-term affordability. That's why investment dollars increasingly flow toward faster-growing metros. Not because the Northeast is broken, but because opportunity costs have changed. Why fight resistance when momentum exists elsewhere? Capital doesn't argue. It reallocates what the Northeast still has and what it lost. This is where the story becomes more complex. Because the Northeast didn't lose everything. It still has world-class universities, deep financial markets, cultural density, global relevance, but it lost something subtle. It lost inevitability. For decades, success and the Northeast felt inseparable. Today, success has options, and options dilute power. The pricing trap. Here's the danger zone for mature markets. Prices reflect yesterday's demand, but buyers evaluate tomorrow's value. That gap creates stagnation. Sellers wait for peak pricing. Buyers wait for correction. Transactions slow. And when markets stop moving, narratives shift from growth to defense. Defense is not where momentum lives. History repeats, just not the same way. This isn't the first time a dominant region faced redistribution. Manufacturing once defined the Northeast. Then it moved. Finance concentrated here. Then digitized globally. Real estate followed the same arc. Centralization. Peak dominance. Gradual dispersion. Not collapse. Redistribution. The Northeast's real challenge. The real challenge isn't falling prices. It's relevance. Can the region justify its premium in a world where geography matters less? Can it modernize housing policy? Rethink taxation? Invest aggressively in livability? Or will it rely on history while momentum builds elsewhere? Long pause. Because markets don't wait for nostalgia. They reward adaptation. What this means for buyers and sellers right now. Buyers are no longer desperate. They're selective. Sellers are no longer guaranteed leverage. They must compete. And investors, they're cautious, not fearful. Cautious, which is often worse for volume. A market at a crossroads. The Northeast stands at a crossroads few expected. Not because it failed, but because the world changed around it. And in part 4, we'll answer the final question. Can the Northeast regain momentum? What would it take? And what happens if it does? History is unforgiving to places that confuse legacy with destiny. Because power doesn't disappear loudly. It fades quietly. Until one day, it's gone. Pause. The Northeast now stands in that quiet moment. Not collapsing. Not failing. But waiting. Waiting to decide what it becomes next. Can momentum be rebuilt? The answer is yes. But not passively. Momentum never returns because of memory. It returns because of decisions. And the decisions facing the Northeast are structural, not cosmetic. This isn't about marketing campaigns or skyline projects. It's about fundamentals. The housing question no one wants to touch. At the heart of the slowdown is supply. For decades, limited housing worked for the Northeast. Scarcity raised prices. Prices reinforced prestige. But scarcity in a mobile economy becomes a constraint. You cannot grow if you refuse to build. And growth is the oxygen of real estate. Without it, markets stagnate, even if they never crash. Taxation and the price of staying. High taxes once bought world-class services. Education. Transportation. Public institutions. But buyers today ask a harder question. What am I getting for what I'm paying? That question grows louder every year. And unless taxation aligns with visible value, migration doesn't reverse. People don't leave places. They leave equations that no longer make sense. Cities must compete again. For generations, Northeast cities didn't compete. They commanded. But in today's economy, cities are brands. They must attract residents, employers, and builders. That means streamlining regulation, encouraging innovation, making living, not just working, appealing. Without these shifts, talent flows elsewhere. And talent always brings housing demand with it. The danger of flat. There's a scenario worse than decline. It's stagnation. Prices that don't fall, but don't rise. Sales that happen, but slowly. Markets that feel expensive, without feeling exciting. That's where long-term underperformance begins. Not with crashes, but with boredom. Who will be hurt the most? Ironically, it's not luxury buyers. It's the middle. First-time buyers locked out. Young families forced elsewhere. Local workers priced beyond reach. When a region loses its middle class, it loses momentum permanently. Because real estate doesn't run on extremes. It runs on volume. The Northeast's hidden advantage. And yet, the Northeast still holds something powerful. Density of ideas. Cultural gravity. Global recognition. These are not small assets. They simply need to be activated for a new era. Remote work doesn't eliminate cities. It forces them to justify themselves. The choice in front of the market. Every cycle asks a question. This one asks, will the Northeast adapt? Or will it defend the past? Defense feels safe. But offense wins markets. Regions that embrace change early don't just survive. They lead again. What the next decade will reveal. In 10 years, the answer will be obvious. Either housing becomes more accessible, growth stabilizes, momentum returns slower but real, or the Northeast becomes a premium niche market. Expensive, stable, but no longer dominant. Not dead, just secondary. And history will record that shift not as a collapse, but as a choice. Final thought. Real estate is never just about buildings. It's about belief. Belief in opportunity. Belief in growth. Belief that tomorrow is worth buying into today. The Northeast built America's economic foundation. But foundations don't guarantee the future. Only reinvention does. And the momentum clock is already ticking.